Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Upstream Bio Inc. Annual Report. Upstream Bio Inc. provides a range of businesses and services that support the development of treatments for inflammatory diseases, particularly severe respiratory disorders. At the core of its offerings is the clinical stage biotechnology treatment, Verikidug, which is currently undergoing Phase 2 clinical trials for severe asthma and chronic rhinosinusitis with nasal polyps. Additionally, Verikidug is being tested in a Phase I clinical trial for treating chronic obstructive pulmonary disease, COPD. Upstream Bio Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. Upstream Bio Inc. trades at a lower price-to-book ratio of 1.56 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 2% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. Net income decline. A critical analysis, the company's net income has experienced a significant decline, decreasing by $80.6 million from 2024 to 2025. Furthermore, the company reported net losses in both years, indicating a persistent financial struggle. The primary reasons for this decline are multifaceted and can be attributed to increased legal and financial compliance costs, lack of regulatory approval for products, high research and development expenses, and limited cash resources. Profit margins remain unchanged. Notably, the company's profit margins have remained unchanged due to its consistent reporting of net losses. The absence of information on previous years' profit margins further exacerbates this issue. To rectify this situation, the company must address the underlying causes of its financial struggles and implement strategies to improve profitability. The decline in net income is a pressing concern that requires immediate attention from the company's leadership. By understanding the root causes of this decline, the company can develop targeted solutions to mitigate these issues and ultimately restore its financial stability. The company's financial performance has been a subject of concern, with one key issue being its inability to generate positive operating cash flow. This is evident from multiple pages in the report, which consistently state that the company is not producing sufficient cash from its operations to cover its expenses and investments. According to the report, the company's net losses and negative cash flows have been major contributors to this problem. Despite efforts to address these issues, the company has yet to achieve a positive operating cash flow. This lack of progress raises concerns about the company's long-term financial sustainability and ability to meet its obligations. Management at Upstream Bio Inc. is optimistic about the company's outlook, with a clear focus on developing treatments for inflammatory diseases. The company's strategy centers around advancing its lead candidate, Verikidug, through separate Phase 2 trials and eventually into Phase 3 trials in severe asthma and chronic rhinosinusitis with nasal polyps, CRSwNP. By maximizing efficacy without biomarker restriction and utilizing quarterly at-home administration, the company aims to establish a strong presence in these markets. Financially, management is confident that existing cash reserves will be sufficient to fund operations through 2027. However, they also acknowledge the need for future financing, which may come from equity offerings, debt financings, collaborations, or licensing arrangements until substantial product revenue is generated. Despite facing various risks and uncertainties associated with drug development, management remains committed to advancing Verikidug through clinical trials and securing necessary funding to support ongoing operations. efforts. The company has made several strategic moves through acquisitions and divestitures to shape its business landscape. In terms of acquisitions, the company has acquired assets from Astellas, a significant move that is expected to bring new capabilities and opportunities. Additionally, rights and licenses were granted under the Lonza license agreement, further expanding the company's portfolio. On the other hand, the company has also made divestitures, including settling the Series B preferred stock tranche right liability in April 2024. This move marks a strategic decision to streamline operations and focus on core business areas. Supply chain disruption concerns loom large. The extracted summaries reveal a plethora of concerns regarding supply chain disruption. One of the primary concerns is the lack of long-term agreements, which can lead to supply chain de-risking, page 32. This vulnerability is further exacerbated by the reliance on third-party data and manufacturers, as seen in pages 56 and 78. The dependence on these external entities can result in potential disruptions due to legislative actions, trade tensions, and non-compliance with environmental regulations, pages 105 and 91. Furthermore, the conduct of clinical trials may be impacted or limited by the reliance on third-party manufacturers, page 74. This can lead to difficulties in scaling up production to commercial quantities, resulting in supply chain disruptions. The potential for delays or interruptions is also acknowledged in pages 55, 56, 78, and 116. In summary, the extracted summaries highlight significant concerns regarding supply chain disruption, primarily due to reliance on third-party manufacturers and data, legislative actions, trade tensions, and non-compliance with regulations. That concludes the financial summary for Upstream Bio Inc. Feel free to comment below, and I will be happy to answer them when possible.